In this video, I'm going to be going over some of the investing myths which could be holding you back financially. Now, the first one is that you need to be an expert or smart to invest. It's true that investing can seem daunting. With there being so many types of investment options to choose from, things can get confusing quite quickly, but it can be simple and straightforward if you take the time to research. And there are plenty of resources available that can help you learn the basics and make a more informed decision. There are things such as index fund investing that can simplify the process and offer a way to participate in the market without having to constantly monitor and trade individual stocks. A common myth or misconception is that when you buy more stocks, you automatically have more diversification. On the whole, this can be true, but there is a difference because there is such thing as correlated and uncorrelated stocks. If you had bought all the stocks in the leisure and hospitality sector only, then your portfolio would have suffered during the pandemic. If you buy from just one sector, then it's an issue because if that industry fails or does badly, then the entire portfolio crumbles. Diversification involves spreading investments across different sectors, industries, and geographies to reduce the risk of loss due to any single event or market conditions. The stock market can be affected by world events that may cause stocks to go up or down. And when this happens, it's easy to look at your portfolio and think for the worst. If your stock has gone down by 10 to 20%, you only have a loss if you take your money out. Until then, it's just all numbers on the screen. Long-term investments have historically recovered from market crashes over time, so long as you've invested in a stock or index fund that has shown long-term growth like the FTSE 100 or the S&P 500. Having the right mindset can help you avoid panic selling, and this can result in locking in losses and potentially missing out on future market recoveries. If you look throughout history, you'll see that the stock market has had many crashes like the dot-com bubble, the recession of 2008, and during the pandemic. The stock market always eventually bounces back, and there has been a long-term trend showing it increases over time. Knowing this should give you peace of mind and will allow your investments to increase if you give it time. The next misconception is the idea that percentage gain is equivalent to percentage loss. This concept allows you to determine things like your rate of return, your gains, or even your losses over a set period of time. It helps you to better understand where you sit financially. Understanding this is important in investing, as these are two different things. Now, say your stock goes down by 50%, then a few days later it's raised by 50%. You may think that you're on the same level and back to where you started, but this is wrong. If you started at $1,000 and it went down by 50%, that's $500. If that goes up by 50%, it's $750. So it's still not at the same level as before. It's an easy misconception to make, and our minds can trick us into thinking like that. Buying the dip or trying to time the market is another misconception, because you can say I'll buy shares when they reach the very bottom, but you never know this. It's only after a stock hits the bottom that you'll know that was the rock bottom, making it challenging for anyone to buy low and sell high. Another factor is that market conditions can worsen, so a dip in the market can quickly turn into a full-blown downturn, making it harder for investors to recover their losses. On the flip side, there is also the emotional decisions. When the market drops, emotions can run high, leading investors to make impulsive decisions, which is why it's best to dollar cost average your investments. So instead of putting a lump sum into the stock market, you can even that out into smaller amounts at a regular interval. This means you'll eventually balance out where you are buying at. The next one is buying just because the price has fallen. Stocks can decrease in price when there's a recession or a market correction. Say if a stock had reached a high of $30 but has since fallen to $10 per share, and we can compare that to another stock and say that's gone from $5 to $15. Now, the majority of investors would be tempted to buy the first stock because they believe the stocks will return to those same levels again. Buying every stock because the price has fallen isn't a good strategy though, because there are many factors to consider about the company. Thanks for watching. I hope you enjoyed the video. If you want to learn more about investing, you may like to check out my other video over here.